Welcome everyone. Welcome everyone to our second conference call here at Prospera Energy. Happy to see everybody back here for this new initiative that we've taken on as a goal of our ruthless transparency, sharing a little bit about our corporation on a monthly basis, along with the recently updated Key Walls report that has been uploaded to the website as of this morning, and the updated corporate presentation as well. Um, yeah, thank you for everybody that's joining. Anybody on the Twitter Spaces that would like to join for the slides and presentation, please feel free to click the link in our last news release, and you can join for the slides portion as well. Other than that, we will get started here. This presentation here, as we evolve throughout 2026, will now start to include a macro outlook portion of it, along with a bit of a technical review as well on some of the strategies that we're working on. We are familiar that some of the investors involved here in Prospera are wanting to know a bit more about what's going on as we prove out our strategies. We prove out some production engineering techniques, and we bring these wells back from being offline for 10, 15, 20 years. Very excited to share the progress of 2025. That was in last month's recording, which is available on YouTube, and looking forward to just keep this progress going here. So definitely sharing that this is forward-looking information, some of which will be shared today. So please read this disclaimer here. A lot of this is going to be forward-looking information that we share. The agenda for today here, we have a very brief macro outlook for this presentation. The following presentations will start to build on this as we go. We have operations and key wells update on the Prospera itself, on our core strategy, a bit of a financial update based on the changes over the last month, the equity private placement, which is currently open, which Chris will discuss, and then a brief technical presentation talking about some of the more fun, nerdy stuff, if you will, about what's happening with the corporation geologically, explaining some of our pools a bit more. Why is this so interesting to an investor beyond just the base company, a conclusion, and then the next steps here as well. So we'll get started with the macro outlook. The two pieces that are at the core of the structural bull market. The structural bull market started in about 2021. It's had its ups and downs with a fighting between supply, demand, inventories, and geopolitics, all of which play a major role. But at the crux of the structural bull thesis are two key points: OPEC solidarity and US shale production. On the left side here, you can see, despite OPEC adding a lot of barrels over the last 6 months, which they were meeting their quotas, they've now started to drop off. Once that initial flush came in, we've now started to see some issues with supply in Kazakhstan. We're starting to see issues with supply in Russia, and Saudi Arabia being the only real member that's for sure maintained up to their quota production. Very, very important piece to track going forward. And also important to see what OPEC does here at the next meeting when they will decide their Q2 changes going forward. But overall, hasn't resulted in the huge, massive inventory increases that were being predicted back in November, December, and spot pricing overall also holding on very strong. We'll continue to track this over time. Of course, geopolitics plays a massive role in OPEC production as well, with numerous countries in a bit of a war zone, if you will, at current moment. On the right side here, the graph we have is the US shale production graph. Overall, tight oil production. We saw the huge hyper growth phase, as you can see here, as the first phase from 2016 to about 2020. We saw the COVID recovery phase, which involved lots of rigs, high pricing environments, and also the reduction of the drilled uncompleted inventory. And now, over the last 6 to 12 months, we're in basically a no growth phase. And it's been a complete step change. It hasn't been a slow, gradual slowdown. It's been a complete slowdown. And will be very interesting to track this as well going forward as the next few months and the next year goes by. And you can see at the crux of that lowering of the US shale production growth rate, we have on the left here the rig count, which has consistently kept dropping here over the last 3 years. especially if you look at the Texas number there, is down almost 50% in that 3-year time frame, mostly in the Texas basin of the Permian, and also the Eagle Ford is down quite substantially. So very interesting trend starting to develop. Yes, rig efficiency has gone up. Yes, completions efficiency has gone up. At the same time, we are continually seeing rigs drop, continually seeing consolidation across the industry, and that trend is set to continue going forward. No company wants to go out there and say we're growing massively. The market's just not rewarding them. On the right side here, we have the frac spread count, again, down about 50% here over the last 3 years, and continuously dropping more and more here as some of the smaller players get bought out, as there just isn't the commodity price environment really in order to push companies to really expand production here. And inventory is dwindling. No company wants to waste their remaining very precious inventory in this $60 oil environment, which is strengthening here as we go. But just no company wants to waste this for no reason. When the market's not going to reward you, you have precious reserves, you have precious inventory. There's no point blowing it out for no reason. So going forward, we'll have more and more macro outlook, deeper updates going forward. But wanted to begin the February here, bringing it back to some of the global changes that matter here as we set up for this further strengthening of the structural bull cycle. It's not going to happen tomorrow. It's going to happen over a period of time and keep building to a stronger and stronger supply-demand outlook as we go here. Coming back to our core strategy, in January, we shared our overall field production and field strategies. Again, for investors that have not seen that, the recording for that is available on YouTube. And this specific presentation, we want to focus on our core strategy, which is the loose land reactivations. This prolific reservoir where wells have been left down for 10, 15, 20, 25 years. We've come back, we've reactivated some of these wells. And throughout 2025, the question was, is it going to work? Are the wells going to deplete? Are they going to sand in? Is there going to be major production problems with this? Are you going to be able to actually keep these wells online? That's the strategy we had to prove to ourselves, to our board, to the investor base, to the community in general. And we've now got multiple wells showing this, including, as you can see here, 16 of 7, our absolute star performer. Upwards of 30 barrels per day here. We did hit 33 barrels per day for a small period of time and then just slowed the well down slightly in order for it to maintain that steady 15 joints of fluid, maintain that strong sand production, not have the water cut rise. And we're just continuously monitoring this. This well started off, as you can see, at 4 or 5 barrels a day. There's a lot of question about why are we producing this well. Steady step changes in production. And like I said, we still have 15 joints of fluid here of optimization potential, but we're not going to mess with this well for now. It's our top well. Keep it steady at that 30 barrels per day and just keep it chugging while we work on some of the other wells. Second well here, 4 of 33, produced very strongly in that April, May, June timeframe, upwards of 23 barrels per day, but we just pushed it too hard. It ended up sanding in. We've now brought it back a lot slower, and you can see how we're working this well on a very phased, tranched mechanism, slow RPM speed ups, and just waiting for that sand influx to come in with the oil, producing that effectively, and then slow playing this as the well comes back. We do want to produce a lot of sand out of this before we really push the well, because if we push it too hard and that sand comes in all at once, well, then it's going to sand in again. So really diligent focus on production monitoring, field operations, but also reliability. We would rather produce the well slowly and it produce for a long time as opposed to jack it up and then ends up sanding in, requiring workovers. And then we have our 10 of 8 well, again, slow, steady, incremental speed ups, now at a steady 20 barrels per day. This well does not have a recycle pump on it, so we're being very careful with it, making about 6 cubes of total fluid per day at about a 50% water cut, and just monitoring this one day to day, taking regular fluid shots, taking regular well head cuts. 20 barrels a day for $150,000 is just exceptional. Really strong paybacks, really strong netbacks with the oil cut. being upwards of 50%, and with the trucking being so close to our battery, uh, we just want to keep producing. And as you can see, some of these wells are now 8 months into their production life without having any sort of pump issue, rod issue, or any type of other problem that causes it to go down. Three more wells here. At the top, we have our 10 of 7, which has been a fantastic performer. It does produce at a higher water cut, so it's been flow line to the battery, as opposed to being a single well battery where oil has to be trucked out, water has to be trucked out. A steady eddy 23 to 24 barrels per day. We did slow this down slightly in early January to prevent any type of water coning and channeling. And therein lies the rub. We are not after maximizing barrels to show investors, oh, we have a huge barrels here. We're about maximizing netbacks, maximizing reliability, and making sure the wells are staying online for a long time, as opposed to channeling the wells with water and then the well just slowly dies out over a period of time because the water handling costs become too high compared to the oil that it produces. In the middle here, very, very happy with this 3 of 9 well. It had come on exceptionally strong in March. It produced until about late July, early August, at which point a well load operation was performed, which ended up causing the well to sand in. We immediately got the rig on site, got it reactivated in early September, and just have kept pushing this well slowly and steadily. It's now upwards of 25 barrels per day as well. So you can see there is a ramp up period here on these wells. It's not get the well online, it's producing at max rate, and we're good to go. These are phased speed ups with just more and more barrels as we go. And as those barrels come online, we're reducing operating costs per barrel, and we're getting more out of the same well. So in essence, what we call the negative decline rate model, because we're not pushing these wells to their maximum limit, we're producing them at a slow, steady, consistent rate, still making incredible netbacks, incredible cash flow out of these, while really, really focusing on the proper production engineering and field operations techniques. The reason some of these wells are down is because previous companies just pushed them too hard, sanded the well in. They kept sanding the well in by pushing the well too hard, and then eventually they just walked away. So we know what we have here is a multi-decade reservoir, a prolific rock here, upwards of 2 Darcy permeability. We want to produce these wells for a long time, have really good sustainable cash flow for that period of time, which requires a bit of financial and production patience upfront. But at 23, 24 barrels per day, for again that roughly $115,000 or $150,000 cost to reactivate a well, those are some incredible paybacks compared to some of the new drills that are happening in Alberta, Saskatchewan. And then we have 7 of 33. This well is in section 33, which is one of our lowest recovery factor pools, a part of the pool, about that 2 to 3% recovery factor. And as you can see, produced very, very strongly for 5 to 6 months. And now we're in a sand influx phase. I'll talk about this later in the technical review portion of the presentation, but we have had a wormhole propagation. We have had that sand influx come in, and we have kept this well running for the last 90 days through that sand influx phase without the well sanding in. Super flushes, well loads, constant sand cuts, wellhead cuts, and fluid levels. Upwards of 8% sand being produced at this, which is awesome. As that sand comes in, it really cleans up that wellbore, it cleans up the perfs, it cleans up the near wellbore area, allowing that sand, that oil to then start flowing in over time. And permeability is a exponential relationship to porosity. As that sand comes in, you effectively have complete void in that part of the wellbore, allowing that oil to really flow very, very easily. What we're doing now after this 90-day phase, we've produced what we think is a really, really good amount of sand. We are now going to go back and start to hold fluid level here. We're going to bring the well back to 5, 6, 7 joints of fluid, have that head pressure on the reservoir to keep the sand from just caving in constantly. And we're going to start to bring oil back into this wellbore and the pump. So very excited for the next 5, 7, 10, 15, 20 days here as we hold that fluid level, bring that oil back, and we'll report some updates on this through the key wells report. And most importantly, well profitability. We shared this table in last month's presentation as well. You can see how this is our top 10 wells here with the net operating income per well. And you can see on these 10 wells, we would have spent about 1.5 million roughly on the total reactivation costs on these 10 wells. And in just Q4, we produced about $360,000 of net operating income. And some of these wells weren't even at peak in Q4. As you saw some of the graphs, we've kept adding barrels as Q4 and then now Q1 has gone on. We've also kept obviously seeing some increases in oil price, which naturally flow to the top line and the bottom line on these wells. We will now be reporting this on a monthly basis on the key wells report going forward. So investors can expect to see an update of this table over the next 2 to 3 days in our key wells report, and then will be reported monthly going forward. But shows you the incredible return on payback periods and netbacks on these wells that we're seeing, and not just the first payback, but second, third, fourth, fifth payback as the next couple of years go on, allowing for that payback to fund the additional reactivations going forward. And we'll pass it on to Chris here. I will make a comment. Anybody on the Twitter space that would like to join for the slides, the Zoom link is in our last news release that was published here a couple days ago, and you can join us on the Zoom. Over to you, Chris.
Thanks, Shabam. Absolutely exciting. I love the passion, and it's exciting because first of all, the strategy is working. We're seeing the wells come online, progressively producing more and more over time. But you see this amongst the team. The team's absolutely excited about the work that they're doing and the additional development opportunity we have going forward. And one of the pieces here that I see from a financial standpoint is that we need a proper capital structure that can support the continued scale up. And as we develop the 140 reactivation opportunities, as we bring on additional production, we need a balance sheet that can support that properly. And so, this slide is really about the balance sheet optimization that's currently underway. And so, Prospera is proactively deleveraging the balance sheet. And it's initiated a structured and proactive deleveraging process that's focusing on reducing absolute debt levels and simplifying the capital structure. We're engaging constructively with senior, subordinated, and GOR stakeholders to align the balance sheet with the company's current production, scale, and cash flow. And this also includes targeted AP reductions that are also in progress, working very actively behind the scenes to reduce the debt that's currently sitting on the balance sheet. And so you can expect to see more of this from us going forward. A core objective of the conversion program is alignment of stakeholders with equity value. And so this conversion program is to better align legacy creditors with long-term equity value creation. It also is creating financial capacity for scalable growth. And that's the underlying rationale behind this. So that balance sheet optimization is not just an end in itself. It's actually intended to create the financial capacity required to support disciplined production growth. And as leverage metrics improve, we expect Prospera to broaden its financing alternatives and strengthen its overall market position. Next slide there, Shabam. So this slide is I mentioned already, is about a disciplined path towards 1,200 barrels a day. The company is hyper-focused on this, not only to increase production and top-line revenue, but free cash flow at the end of the day is the primary driver here. So Prospera's path towards the 1,200 barrel a day, primarily driven by low-risk reactivation activity rather than exploration-dependent growth. We've talked about this early in the presentation and in previous conference calls. But as you can see from Shabam's initial slides, the Luseland program is fully scoped and represents repeatable short-cycle production additions layered onto a stable base. This scale unlocks financing optionality. Reaching the 1,200 barrel a day range is strategically important as it typically the threshold where broader lending and structured financing options begin to open up for companies of our size. The current program is specifically designed to move the company towards that scale in a disciplined, capital efficient manner. And this is execution driven, not price dependent. So importantly, this growth trajectory is execution driven. It's based on identified well work and existing inventory rather than relying on higher commodity price or drilling opportunities. And that gives us a higher degree of control over the growth profile and improves visibility for both investors and lenders. And at the end of the day, this is a controllable path to scale with as much de-risking as we can impose on. Next slide, Shabam. This slide is really an extension of what we've been talking about. So high return reactivation model. Prospera continues to prioritize capital allocation towards short cycle, high return reactivation opportunities. And in the previous conference call, we talked about equity raise of $3 million, deploying $2 million into the ground and adding 250 barrels a day, essentially adding up to $2.5 million or more in current commodity price environment. Annual field cash on cash returns are greater than 100%, and we're seeing less than 12-month paybacks. And so I'm repeating myself from past conference calls because this is really the meat of the program that's being employed. So the strategic implications of this are rapid conversion of capital into cash flow, lower technical risk relative to new drilling, repeatable inventory, and a progression towards internally funded growth. And the key takeaway here is that our reactivation strategy represents a capital efficient growth engine that's capable of generating near-term cash flow while preserving balance sheet capacity. What this does is it repositions the company for equity re-rating. Prospera's current operating and financial initiatives are designed to support a structural improvement in equity valuation as execution milestones are achieved. So measured production growth from low-risk reactivations, progressive deleveraging through the balance sheet optimization. These are the value drivers that are supporting free funds flow inflection profile, which we'll see on the next slide. Strengthened financial resilience through the balance sheet cleanup and potential expansion of institutional investor interest, leading to higher share price. The potential market outcomes here are improved leverage metrics, higher EV per flowing barrel, broader access to capital, and the share price re-rating that we just talked about. And the key takeaway is that as operational execution and balance sheet optimization advance, management believes that Prospera is positioned for improved market recognition relative to its current trading value. This slide here is a reflection of changing commodity price environment. So free funds flow sensitivity, essentially, at the end of the day. 2 million of capital is being deployed in Q1 and Q2. And what this slide is intended to illustrate is that a cash flow inflection embedded in the current program and how sensitive, or importantly, how resilient the model is across the various WTI ranges. So capital timing, I mentioned, you'll see approximately 2 million of capital deployed across the first half of 2026. This is primarily tied to the loose land reactivation program and targeted workovers. As expected, the front end investment is temporary pressure-free funds flow in Q1 and early Q2. The important point is what happens next. So as the reactivated wells come online, we see a clear step change in free funds flow beginning in the second half of the year. By Q3, the program transitions from investment phase to cash generation phase across all price scenarios. And I must emphasize, this is short-term, short-cycle capital model with rapid payout characteristics. The commodity resilience, which is very important for the funds. And so even at $60 WTI, the model turns meaningfully free funds flow positive in the back half of 2026. at $70 to $80 WTI, which is broadly consistent with the recent forward strip, the cash flow expansion becomes increasingly material. So in other words, the strategy doesn't require a high commodity price environment to work. From a balance sheet linkage standpoint, from a capital allocation perspective, this free funds flow inflection is expected to support ongoing net debt reduction and improve overall financial flexibility as we progress through the year. As execution milestones are delivered, management believes this cash flow profile should support a progressive strengthening of Prospera's leverage metrics and overall equity positioning. And the key message here is that Prospera is moving from a capital deployment phase into a self-funding profile with meaningful torque to both operational execution and commodity pricing, while maintaining resilience at the lower end of the price range. As Shabam mentioned earlier on in the presentation, we do have a private placement that's currently open. It's a $3 million non-brokered offering at 3.5 cents. With the target close date of actually March 15th. So this slide is slightly dated. The offering has been extended to March 15th. We've had some very supportive participation to date and are looking to fill the full offering. The offering consists of one common share of the company and one common share purchase warrant. The warrant is exercisable for a period of 3 years at a price of 5 cents. Talked about this earlier. The use of the funds, $3 million, approximately $1.5 million of this is going into the loose land reactivation optimization program, $500,000 into the Cuthbert workover program, and approximately $1 million of working capital, and that supports the balance sheet deleveraging. The result expected is 250 barrels a day of incremental oil production, and an increase of 2.5 million to the 2026 annual field cash flow. You can reach out to either Shabam, myself, or Sean, who's also on this call, directly for further information related to this private placement. Shabam, I think that's the end of my slide. I'll pass it back over to yourself.
Yeah, thank you, Chris. Appreciate the forward-looking piece there and sort of what we look to do here as 2026 continues. It's no surprise to investors that we have proved out our strategy. We've stayed resilient through a $57 to $63 oil price environment over the last 9 or 10 months. Very successfully proved out that these reactivations work, and we are ready to scale. And it's important to mention this the short cycle piece. If we get a rig in on a reactivation on Monday morning at 7 a.m. by 4 p.m. on Tuesday, that well is spinning and making oil and making cash flow. These are not long life projects with huge capital. It's a relatively straightforward process of going in and starting these wells up and getting them moving. So we're able to use capital very, very effectively. Now I'll share a brief technical review here on some of the additional items that investors would find interesting here as part of what we're doing. Obviously, some of you who have been following me since the White Tundra Saturday session days are familiar with these kinds of presentations, and something that I've been looking forward to do for a long time here, get back to it. So we'll do it in within the lens of Prospera to begin with, and then looking forward to expand these presentations into deeper and deeper technical reviews as the rest of the year continues. So on the left here, we have the wormhole propagation. When I talk about wormhole propagation, what does it really mean? Is we have these vertical wells, which you can see here in red, and we have a upwards of a 14-meter thick sand body that accompanies this well that's sitting in the earth. And how does that sand body produce? It doesn't just produce in a very, very clear manner the way that people potentially board airplanes. It produces just haphazardly wherever the pressure drop happens, wherever you have sand grains that are the most unconsolidated. As that void starts to get bigger and bigger, it starts to expand out horizontally into the rest of the earth. So what you're seeing here is a demonstration of what that could look like underground. And You have these various branches, almost like a tree, that are going out. And when we say we're trying to create wormhole propagation, we're talking about two things. One is extending the wormhole out more horizontally by producing the sand from the wormhole, by removing the restriction, by creating a larger pressure drop across your wellbore. You're able to bring more of that sand in and allow for more of that sand to collapse and more of that oil to flow towards the wellbore. So that's the first thing we're trying to do. But also, we're trying to create new wormholes. So because a lot of sand has already been produced, a lot of oil has already been produced from this wormhole, we want different kinds of wormholes to start connecting and producing more from this matrix area, which is very, very saturated with oil and sand and fresh oil with foamy oil flow on it, with a lot of oil saturation, allow it to start to move towards the wellbore, and you get these really, really high rates that can come in. We're able to track this through the fluid level monitoring, through the sand monitoring, and also through gas monitoring. Some of the oil that's in these matrix has a lot more gas trapped in there as opposed to some of the wormhole oil. So we're really able to track this by being very diligent with our data collection. Um, and allowing us to really understand how these wells are performing. A reminder, our wells are on 40-acre spacing, which means they're about 400 meters apart between the wells. So there's a lot of reservoir there. Think about a 14-meter thick reservoir that's 400 meters wide on each side of that well bore before you hit that next neighboring well. So there's a lot of oil here yet to recover. And that's exactly the strategy we've proven out here over the last 15 months and will continue to prove out here as we go. On the right side here, you have a picture of the different kinds of oil that we have. So we are about in this 10 to 12 API range. You see here, very, very dark oil, mostly used for diesel and heavy asphalts and whatnot production. But you can just see the kinds of oil that we have here. And one of the very interesting things is we can know when oil is being produced from the wormhole versus the matrix by the color of the oil. As you get fresh foamy oil, it will lean more towards this browner color. It's not quite 22 API, but it will lean towards a browner color and have more pressure to it in terms of the gas dissolved in there. So really this ability to mix production engineering with reservoir engineering and field operations alignment to really track what's going on, not just saying, oh yeah, it's making 5 barrels a day or it's making 10 barrels a day. That's the strategy that doesn't work. You have to have a focus on a well by well by well monitoring, and that's what caused other people to not succeed and our strategy to succeed. We're not really doing anything that's absolutely game changing or a brand new technology here. We're just doing it with a lot more focus, uh, many orders of magnitude focus higher. And you can see on the bottom here a graph, a picture of how this wormhole propagates. Again, you can see how different sand bodies will produce first, just depending on grain size, depending on the pressure, depending on the consolidation, the porosity of that lateral bed. There's a lot more science here that we're still figuring out. We don't have all the answers. Nobody in this room can look 700 meters underground and have this X-ray vision to see what's going on. We are taking the data we get on surface and then extrapolating, trying to understand what's going on downhole. The more data you have, the better, and the better quality data you have, the better, allowing us to really build. And I think the big picture there is we've learned a lot from the initial few reactivations we've done, allowing our next set of reactivations, of which we have 41 we'd like to do in 2026 overall, to be a lot more efficient, to scale up a lot faster, to get to their peak rates a lot faster, without compromising reliability, without compromising any type of sand issues or any type of pump longevity as we go. Quick reminder, anybody on the Twitter space that is wondering what I'm talking about, you can join the Zoom link through the last Prospera news release that was put out a couple days ago, and you can join us for the slides version of this as well. Moving on to some of our wells. On the left, you see here one of our wells from Section 17, the 11 of 17 well, which was brought online in December after it had a long history. You can see here we have 45 years of production history. These aren't wells that just produce maximum rate for a year and then bam, they die off and they're gone. These wells will produce for multi decades. You can see here a very low water cut on this well, as low as about 15 to 18% over its life. And it's produced almost 470,000 barrels in its 40-year lifespan. At its current rate of 10 to 12 barrels per day, we're only producing 5,000 more barrels per year. So there is a lot of reservoir here to go, especially as we start allowing that wormhole to propagate and start making more and more oil. In the middle here, I'm showing you a well that's produced for 80 years almost, and has produced at these kinds of rates, and just kept going at that low water cut and just kept producing. So when I say these are multi-decade reactivations, I'm not just saying that because, oh, I had a dream or I think so. It's we're looking at adjacent wells of some sort that we can find that have similar characteristics and have produced. The reason most companies walk away from this, other than poor production engineering, other than sanding in, is you can see on the right. A lot of these wells will water out. As you start producing more oil, more matrix, that green line is oil, the blue line is water. At some point, that water rate gets too high. You got to shut the well in because even if it's making oil, the economics just don't allow you to produce that. Well, well, we have very low water cuts. Not only do we not have bottom water in a large portion of the pool, our residual oil saturation is about 70%. Same with our initial oil saturation. So we have a lot of oil in this reservoir compared to water, allowing us to say very confidently that the good reactivations will produce for another 20, 30, 40 years. That plays into cash flow, that plays into production profiles, and how fast you can grow a corporation. That plays into your netbacks over a period of time. That plays into your reserve life, and that also plays into what multiples are the market willing to give you. If you have a well that'll produce for the next 20 years and you have 50 of these wells at the same rate, what valuation or multiple would the market give you on your today's cash flow versus a company like a shale company that's declining 50%, 30% year after year after year and having to put massive capex into the ground in order just to keep production flat? Think about the different business here. These are not same companies. A conventional heavy oil producer is fundamentally different than a unconventional shale producer. And as you can see here in the middle, we have our loose land map. The black dots are the active wells. The dots with the line in between them are the suspended wells. You can see we've really focused. This is just loose land north. We also have loose land south with quite a few wells active, including section 33 with a 2% recovery factor. But in loose land north, you can see we've really focused on section 17 and 18 and started to see some really good wells on the northeastern part of the pool. We are slowly moving west and starting to reactivate some more wells in the west. We have some really good wells in section 7, as I showed. We had some really good wells in section 8, as I showed. But on the northeastern part of this, we have what is called an up-dip edge of the pool. It looks like this, not exactly, but basically you have oil trapped on the up-dip edge with a completely impermeable shale layer on top and a completely impermeable erosional edge on the northeastern side, leading to this very high oil cut, very high netback, and huge oil in place types of wells. And these wells have produced 30, 40 years. They produced upwards of 500,000-600,000 barrels out of these verticals. Why did we focus here to begin with? Because this is your absolutely reliable, low decline, high oil cut, high netback production. We focused a lot on bringing these wells online. Now we're going into some of the higher impact wells, the wells where they haven't been produced as much. There is more sand to produce. There's more wormhole to propagate. There is more barrels to get because some of these wells in section 17 made upwards of 350 barrels a day oil. I'm not saying our other wells are going to do that, but if we even get to a fraction of that, very exciting for $150,000 reactivation. And as you can see, we've already got wells above 30 barrels per day. We've got multiple wells above 22, 24 barrels per day, and still lots of optimization to go. So this is not a story that's just a copy paste. We're still figuring out the science. We're still figuring out how do we get a couple of these wells to 50 barrels per day and keep hitting these higher impact wells on this next phase of reactivation. And I'll end with a bit of a statistics because I love facts. On the right here are the 10 wells in Saskatchewan over the history of the world that have produced more than 500,000 barrels oil with less than 50% water cut. There's only 10 wells in Saskatchewan that have done that. These right here four are the four in loose land that Prospera holds that are that. So we own and produce 40% of the wells that have this kind of reservoir quality. That low water cut results in exceptional netbacks, but also results in longevity because the wells are not going to water out. So we are extremely excited with the results we have so far. We're extremely proud of these Section 1718 reliable wells that'll produce forever. And we now have successes starting to show on the higher impact wells like the 16 of 7, the 10 of 7, the 10 of 8, the 3 of 9, and just ready to scale and launch this thing here over the next few months here as we bring more wells online, but also we continue to get higher barrels out of our wells currently online, as investors who have been tracking us for the last 6 months have been seeing through the Key Wells report. And with that, I will pass this back to Chris for the conclusion, and then we'll end this with a Q&A session. Investors are welcome to put questions into the Q&A portion of the Zoom here, which we'll address here right after the concluding slide by Chris.
Thanks, Shabam. Really, again, exciting to see, the technical side of the business here and how these wells are produced, how they continue to increase, and just how much more opportunity there is ahead of us. Not a lot to say from my standpoint, in addition to what we've already talked about. Kind of wanted to conclude the discussion today here. And start to open up more and more transparent discussions like this going forward. We're going to continue to hold these conference calls once a month. So we invite everybody back, and hopefully we can continue to provide you new detail, keep you updated on progress that the company continues to make. And certainly welcome additional conversations offline at any point in time. This is a conclusion that we had in the previous conference call. And it talks a little bit about the private placement again, so kind of coming back to that piece here. We've had strong support in the current private placement. There is still availability for folks that look to want to continue to support the story on a longer term basis. And just talking a little bit about the dilution. The capital intensity of the loose land reactivation program is expected to be sub $10,000 per flowing barrel, which is much more attractive than what you can go out and buy production for at a very modest, with a very modest risk profile. And so at 8 to 10,000 per flowing, we're accepting about an 18% dilution to generate a 43% increase in cash flow within the current year. These are metrics that compare very favorably to peers, which are relying on 25 to 40,000 per flowing barrel acquisitions. The fact that we actually have an enterprise value that is greater than 50,000 per flowing, the fact that we can add barrels at sub 10,000 just gives you a feel for the amount of leverage that the company has over its current assets and the strength of what we currently own. So, Shabam, any closing words from yourself?
Yeah, thank you, Chris. I think that's it from our end. We appreciate everybody here joining the call. Our emails are over here on the slide for any investors that want to reach out, whether it's for general questions, whether it's for technical questions, whether it's information about the general corporate business plan here, as was discussed, any questions around the private placement, and also just generally to meet. And any current shareholders, any future shareholders, you're more than welcome to stop by. My email is here, and I respond to every email. I'm proud of that. So we'll definitely get back to anyone that wants to touch base. And yeah, our fields are also not that far. So I'm out in the field once every 3 weeks. If there's any individuals here that are landowners or service providers that are in those areas that would like to meet, I'm definitely interested in strategic partnerships and building this company out. We don't see this as a 6-month growth profile. We see this as a proving of a corporate business model and proving of a production engineering model that has been lost for a decade now. because of the low oil price environment, because of the move towards unconventional shale production, because of the lack of capital in this Canadian heavy oil space. When there's massive gems here that you can access without having to drill anything with existing infrastructure, existing sites there, existing wellbores, and we're looking forward to scale this. So definitely exciting times here at Prospera. It's been a hard work year and a bit to get some of the things righted. We are still working hard to get additional items righted, and looking forward to here scale up and go from there. So with that, I'll end the presentation portion. This will be available on YouTube here shortly for any investors that missed a portion of this. The Twitter space obviously is also recorded, so investors can listen in on that as well. And then, like I said, going forward, these presentations will just continue to evolve into more and more and more information for investors. We believe in ruthless transparency. We also have micro content on our LinkedIn page, on the Prospera page, and on my personal page, where you can see us talking about some of these key technical changes and operating cost changes through 1 to 3 minute clips there. Yeah, we appreciate everybody's support and we're looking to build together. So with that, pass it to you, Sean, for the Q&A portion here of the presentation.
Yeah, thanks, Shabam. Looks like we do have, excuse me, 4 questions came in here. Can you please comment on joints of fluid? Why is this important, and what does this tell you about the future production from your loose land wells?
Yeah, I can take that one. So joints of fluid basically tells you how much oil and fluid is the reservoir giving you. And when your reservoir is giving you more fluid, you're able to speed your pump up and start to make more fluid, of which, like I mentioned, because our water cuts are so low and our oil cuts are so high, is a lot of extra oil production. It is important to keep joints of fluid on the well because as that reservoir gives you more fluid, that fluid itself acts like a bit of a back pressure. So it keeps sand from just sloughing in nonstop because there is no back pressure on this. Think of it like a choke, the way you control your shower faucet when you turn it on. It doesn't need to go on all the way. There's a bit of back pressure on that water, so you're holding it back from the true reservoir pressure. And the reason is sand. We don't want wells with massive sand just piling in nonstop. Yeah, although that's great for wormhole propagation, although that's great for overall cleaning up the wellbore, we still need to make money, which means we need to bring oil up with the sand. So it's a phased metric. Some sand, then produce oil for a little bit with sand. Then we might initiate another sand influx phase by pulling joints of fluid down. But effectively, you want to keep joints of fluid on the well to hold that back pressure. It allows you to really play with this knob. It's not simply, oh, the well will give us whatever the well will give us. That's the strategy of people, that have lost focus. They've allowed these wells to sand in. We keep a constant eye on this. And again, we like to maintain some joints of fluid, which allows you to speed the well up. And as we see, if at the same RPM that joints of fluid is keep rising, we got the ability to speed up the pump 5 RPM, pull on the reservoir a bit more, and just this whole sort of iterative process continues almost on a daily to weekly basis.
Looks like we've had quite a few questions come in the last minute here, so we'll jump into the next one. Your top 10 wells have produced 360,000 in total cumulative operating income. How many wells in your inventory are analogs to these 10 wells?
Yeah, I can take that one too. So we have the top 10 wells producing 360,000 in that cumulative operating income. Again, not all these wells were producing at their max rate in Q4, and this was at $58-$59 oil that we're talking. So really, really good torque to not just oil price, but as Chris mentioned, to execution on that production rising over time. We have out of those 10 wells, about 6 of them we can say are about these high impact wells which we've gone to and reactivated. And about 4 of those wells are those Section 17, 18 wells that are your steady eddy 8, 10, 12 barrel per day producers. We don't have too many of those stable wells left. We have maybe 4 to 5 left. We still have the ability to go into the current wells that are active and really push them a bit harder. some of the wells that have been producing for many years before the new management and board team came in here in October of 2024. But we have upwards of 35, 36 of these high impact wells still remaining. So now, not all those wells are going to produce at 30 barrels per day, day one. It's going to be a 3, 6, 9 month phased ramp up process to get to the point where it ends up in our top 10 list. But we've got a good inventory here of about that 41 wells roughly, which we're planning to go after all in 2026. With the current private placement that can push a portion of that, and then B, as Chris showed with the cash flow of the company rising, we can start to self-finance these wells throughout the early summer onwards into the end of 2026 and thereafter.
Next two are both about the debt and equity, so maybe I'll ask these together. Number one, are you able to comment on the extent of success to date on conversions of subordinate debt into equity? And then on top of that, the next one is when you say you're converting your accounts payable into equity or equity price, is what equity price is being used? Are you having success with your vendors accepting equity as payment?
Yeah, I can take this question. So the first question, commenting on the extent of success to date on the conversions of subordinated debt into equity. I can tell you that we're actively involved and engaged with all of the subordinated debt that currently sits on the balance sheet. A large portion or the majority of that subordinated debt is through existing investors or board positions, and we're having very favorable discussions there. The question is actually why hadn't this been done much sooner in time? And the fact is that we needed to prove the strategy out. We needed to confirm that we had the productive capability, that the asset integrity was there. And so now over the last 12 to 14 months, we've been able to establish the fact that the asset integrity is there and that the capability for growth is there. And so the second stage is, of course, now the cleanup. We will actually publish this to the market all at the same time as we proceed through and confirm these conversions. So I don't want to talk too much, but I can say that we are having a large amount of success, and that these discussions, although are more difficult discussions to have on the front end, they actually result in a much stronger equity alignment on a medium to longer term basis. And so that's the rationale for the current undertaking. So in a very similar manner, we're discussing accounts payable conversions, accounts payable settlements, and settlement plans. And so the AP side is a little bit different because these are folks that we continue to work with on a longer term basis. And so we have to be conscious of the fact that we're dealing with vendors that we're going to deal with for the next 5 to 10 years or longer. And so the discussions that we have need to reflect that. We like these debt to equity conversions because naturally there's alignment in what happens here. So the fact that the service reg, the operators, some of our other core vendors are accepting equity as a form of settlement here. Is very encouraging. One, that they view or they have confidence on a longer term basis, but two, they're standing behind us and supporting us here too. So to get right to it, I mean, you've seen some of those conversions already announced in the market. We're typically converting either at or above market value. So we're still conscious of the dilutionary impact that this has. We're often looking at the aging of the AP vendor as well, and looking at if there is a cash component, how can we reduce the AP amount through that as well. Not everything is a debt to equity conversion. I would also add there are cash settlements for lower amounts that are outstanding in order to accelerate this. And there are also longer term settlement plans as well, which involve cash payments. So we use those three forms in our push to reduce the accounts payable that currently sits on the balance sheet, and a large portion of that, as many are already aware of, our AP arrears from prior years. So that all is taken into consideration with the vendors that we're currently negotiating with.
Okay, next question here. Are all of your wells in inventory actually able to be reactivated, or do a number of them need to be abandoned or reclaimed? How many wells need to be abandoned, and how does that affect the corporate liabilities moving forward?
Yeah, for sure. I can take that. So yeah, great answer, Chris. I think I'll just follow this up by also saying that, we are not just going and forcing deals here. A lot of our key vendors have worked with us for the last 15 months. They've understood the strategy. We launched this key wells report early as a way to have that transparency, so they can see what we're doing on a week by week and month by month basis. We invite them to our field and meet with them so they can see the wells making oil and really build that alignment going forward. So I'm actually quite proud of this inbuilt alignment and holding hands moving forward type of strategy. As far as this question goes, yes, so we have about 18 wells that we've identified that are not good reactivation candidates out of the roughly 200 that we have in currently suspended form. Some of those are going to be reactivated, but may not compete for cost of capital at some point in time. There are only though 18 wells that are going to be really abandoned. There's an additional 72 that are under phase ones and phase twos for reclamation that have already been abandoned and cut and capped. What we are going to be moving on in 2026 is a complete comprehensive corporate cleanup and really allowing the company to breathe and move forward effectively. This is not simply being done to meet some sort of metric and all of a sudden we're happy. We are constantly looking for strategic partners who can work with us, who can help us with the reclamation of these wells, who can work with us to really clean up the overall balance sheet. The reclamations and abandonments help us in reducing property tax. It reduces surface cost. It reduces overall dilution of focus of the company, which are all really, really important pieces to us as we rebuild this company from a place where it was about that 15 months ago. So as these wells are abandoned, the corporate liabilities come down through the decommissioning obligations piece of the balance sheet, and really allow us to have better community involvement, better relationships with landowners, better relationships with the MER, better relationships with people in just overall involved in the story. Investors don't want to see a bunch of inactive standing wellbores sitting around. So that at $60 oil, things aren't moving as fast as maybe a guy would like, but we are moving in the right direction. We have the right strategies in place, and we're able to deploy capital very effectively and then recycle that capital into some of this work. So the abandonment plan is set for sometime this summer, and investors will see that show up in that reduction of decommissioning obligations and a reduction of operating costs going forward, because we don't need to weed spray that anymore. We don't need to snow plow it. We can retire some of the sort of operating time going there that can go into more important things. And just really excited to keep this story moving day by day, week by week. Small wins every single day, backstop by 2 or 3 medium-sized wins every week, and then backstop by 1 or 2 big wins every month. And that's going to be the focus of the company, executing every single day, adding value every single day.
That's great. I think we'll leave it there, guys. I know there may be some more questions that come in, but the contact information is both on our NR and the final slide, and this will be uploaded this afternoon on YouTube. So appreciate everyone's time, and we'll see you next month. Thank you.